Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. I'm very excited about being with you today for a couple of reasons. Number one, we're going to start to get into more details as to the different products and services that are so suitable to achieve a successful retirement life. Now, we're going to be talking about a number of things, and I like to give you analogies because usually the majority of my clients enjoy analogies because they can apply it to just about everything that they're doing in their lives. So one of the major issues and concerns that we find ourselves with is how we're going to save money for retirement. You know, what is retirement going to look like at some point in time in the future? And am I going to have enough money at the time of retirement? And will I be able to live a comfortable life in retirement? Or will I only be able to, barely live as opposed to being able to have a good and comfortable life? Now, that is what I call the retirement dilemma. And there are many issues and concerns when dealing with a retirement dilemma. And obviously it's getting more and more complicated in the United States and throughout the world as time goes on. Now, over the last couple of years, especially since the elections in 2016, we have seen the stock market soaring. And the stock market has been going up, but the last couple of weeks, you've seen a correction in the stock market. And it's something that is going to happen no matter what. The markets go up, the markets go down. The challenge for all of us on this podcast and for the majority of my clients is, do you want to try to time the market? And in reality, no one can time the market. Usually if you retire in a given year, and one of the calculations that I do for my clients is I take them through different stages in the stock market history and share with them how their financial life would look if they had retired in those years. So for instance, I would take $1 million portfolio and I would start, let's say, in 1970, and I would run a portfolio based on the rates of returns in 1970. And how well would the clients do, or how bad would the clients do? What if I go to 1975 or 1980 or 1985 or 1990? What if we would have gone to 2000 or 2005, 2008? The world would be totally different from a retirement perspective. One of the major challenges that sometimes I have a discussion with clients about is the fact that most of the people that run illustrations or forecast rates of returns, they do it on a linear basis. The stock market doesn't work on a linear basis. So if you happen to retire in a given year and the market goes down for not only for that year, but how about the next 2 to 3 years, and you have no choice but to start taking distribution out of that account in order to supplement your standard of living, you're going to have a tremendous negative impact on the outcome of that portfolio. If you thought that portfolio may last you 20, 25 years in retirement, it may only last you 13 years in retirement because of the fact that you enter the retirement world at a point in time when the market was heading south instead of heading north. Those are the issues that we need to deal with. Having guarantees in your retirement portfolio, or at least a portion of the assets in your portfolio, is extremely critical if you want to be successful in life. Now, again, because of the market has been going up for the last couple of years, and especially the last year or so, my clients seem to be very excited, and they kind of forget that we did have a 2008, we did have a 2009, we did have a 2010, because bad things we try to set aside and never remember them again. And the other thing I try to tell them is, don't confuse intelligence and know-how with the bull market. And the reason why I say that is that a rising tide raises all ships. So you could be sitting in a bay and all of a sudden here comes, the tide, and all of a sudden all the ships in that bay, the big ships, the medium ships, and the small ships, they're all going to rise with the tide. But only when the tide goes down will you know who is swimming naked. And that's one of the major issues that I try to discuss with my clients on a regular basis. Do not put all your eggs in one basket. Now, again, I want to give you an analogy, which is one that I have used in other podcasts, but this one I'm going to go into a little bit more detail, because at the end of the day, retirement distribution planning and retirement preparation planning, it's about understanding how retirement works. And I'm going to give you an analogy, which is the mountain analogy that I have used for many, many years. And here the story is as follows, and we're going to relate that to retirement planning or preparation for retirement. Now, let's say that all of us here on this podcast want to start training because we enjoy mountain climbing, and we want to be able to climb, some of the biggest mountains in the world, and obviously. The biggest mountain in the world in the Himalayas is, 29,000 feet in change high. So we're going to have to do a tremendous amount of training along those lines. And then once we're ready, obviously we need to buy the right equipment, and then we're going to have to, hire someone who's going to guide us. So we're going to have to pay a lot of money to try to climb Mount Everest. And we have to fly there, and it's going to cost anywhere between $45,000 and $50,000, just to prepare and fly onto that trip and sign up for that trip. Now, obviously, Mount Everest is one of the most dangerous mountains in the world, but you also have one that is known K2, which is probably even more dangerous in many different ways than Mount Everest. Now, for those of you that are on this podcast, please bear in mind that over 70% of the people that have died on Mount Everest have not died on the way up. They have actually died on the way down. And that's a topic that we're going to cover today, and how we're going to relate that to financial planning and retirement. So we get there, and we're at the base of the mountain. Obviously, we're going to have to hire a Sherpa. And these are the people that have, climbed the mountains many a times. And, from time to time, they don't make it. But then again, you want to hire a Sherpa. So when you interview the Sherpa is going to say to you, well, I can definitely get you to the top of the mountain. I just don't know if I can get you back down from the mountain. Now, how many of us on this podcast would hire that Sherpa? The probability that we're going to hire that individual is going to be slim to none, because not only want to get to the top of the mountain, we want to make it down safely. Now, when I have this conversation with many of my clients, the question that I ask to them is, look, if you were a mountain climber and you want to climb Mount Everest, what would be your goal? And almost 100% of my clients tell me that the goal is to make it to the top of the mountain. And my argument is, no, that's only half of the goal. The goal is not only to make it to the top of the mountain, but also to make it safely down the mountain, so you can get to talk about it to your friends and families for many, many years to come. So we have to truly understand that. Now, from a retirement standpoint, as you're climbing the mountain, and we're going to do an example of a 45-year-old that I did some really interesting planning for. But as you're climbing the mountain toward retirement, toward the summit, which for many of us is 65 years of age, or some of you may be 70. In my case, I don't think I'm ever going to stop working. There's a difference between working because you have to and working because you want to. In my situation, I want to continue to work and stay busy, for as long as I possibly can. But when you're climbing the mountain, you're starting to put money away in your retirement plans because you want to save for retirement. You want to get to that summit. And the goal is to get to that summit with as much money as you possibly can from a business perspective. And we'll talk about some of those numbers in a few minutes. But that's the idea of climbing the mountain. Now, when you get to the summit, and you're going to enjoy the summit, for a few minutes or so, because then you have to start coming down the mountain. Coming down the mountain meaning that you're now in retirement. You're no longer producing assets. Now, some of us may work part-time, but many other people, their goal is to reach retirement and not do anything for the rest of their lives. So because of that situation, you want to make certain that you can have as much money as you possibly can when you get to the summit, because from that point forward, you're going to start coming down the mountain and you're going to be spending money. Now, some of us are going to spend money at a quicker pace than others, but by the way, as you climb the mountain, it's all about the rate of return. And that's something that the majority of my clients are very concerned with. But when you get to the summit and you start coming down the mountain, it's not only about the retirement or the accumulation rate as it was in pre-retirement. It's about the distribution rate. So you could have assets, you could have less assets than a neighbor next to you, and you may have a higher distribution rate just because of your planning or the type of planning that you did prior to retirement and the type of products and services that you chose. So all of a sudden you get to the top of this summit and you're coming down the mountain, and the big issue is, well, am I going to have enough money as I come down the mountain in order to not run out of money before I die? So the key thing there is, will your money run out before your life does? And if getting old is bad, getting old and being poor is even worse. So you have to start doing some planning, and the planning may require you to do some tax planning, to perhaps even reduce your standard of living somewhat, to start investing into vehicles that will give you certain tax benefits in retirement at a point in time when you need it most. And you're going to have to do a lot of due diligence along those lines. And obviously, you want to be able to protect your assets in retirement, make certain that, yes, things do happen from time to time, but you want to have as many of your assets protected as you possibly can. Now, as you're ascending the mountain, qualified plans, at least since the early 1980s, have played a major role in just about every single client that I deal with. And your qualified plans would be your pensions, it would be your 401ks, your IRAs. If you happen to be a public employee, it may be your DROP, your Deferred Retirement Option Program, your deferred compensation. It could be your TSAs, and things like that. But then again, these are vehicles that were primarily designed to get you to the top of the mountain. And the reason for that is that the money that you put into these plans, they're pre-taxed, so you're not paying taxes on the money today. The money grows tax deferred. And then once you get to the summit and you start coming down the mountain and you start to take distribution out of these plans, then you're going to have to start paying taxes. Not only will you have to pay taxes on the contributions, but also you're going to have to pay taxes on the growth of those monies. Now, if you're in qualified plans, which are the pre-tax investments, you have a couple of rules. You have the 59.5 rule that you have to deal with. So any money that you pull out of those plans, except for some exceptions, you're going to have to pay taxes and a 10% penalty. And then you're also going to have the 70.5 rules, which are the required minimum distributions, or RMD rules, which basically says that at age 70.5, the IRS is going to force you to start taking money out of these qualified plans. Because if you don't, not only are you going to have to pay taxes on the amount of money that you fail to take out that is required by law, but also you will have to pay a 50% penalty. Yes, you heard me right, a 50% penalty. So when it comes to qualified plans, you pretty much only have an 11-year window out of your entire life in which you have total control of whatever happens. So between the ages of 59 and a half and 70 and a half, that 11-year window, you as an investor have the ability to do whatever you want with your qualified plans. You can take them out. You can take them out little by little. You can leave them there. You can take some 1 year and not take anything the following year. So you have that flexibility. In any other time in your life, the government is the one that's controlling the outcome of those accounts. Now, one of the things that we try to do in the planning that we engage our clients with is that when we do all our due diligence, we want to make certain that our clients, if they're employees and their employer provides some kind of a qualified plan, we do ask them to contribute up to the match. So whatever the match is in those qualified plans, then obviously we ask our clients to contribute up to the match, but never, ever, ever more than 7% of gross income. And the reason for that is that there are many other investments that will allow our clients, when it comes to total diversification, to make certain that not only will they have the ability to make it to the top of the mountain, but also they'll have the ability to make it to the bottom of the mountain with more desirable vehicles from a taxable perspective. Now, this client that I'm going to be discussing with you today is a 45-year-old. And one of the things that most of the people that I have conversations with regarding retirement planning, they tell us the kind of money that they want to have in retirement. They'll say, well, I want to have $1 million in retirement. I want to have $1.5 million, $2 million, $5 million, whatever the number may be. But many of them do not understand how much money you need to set aside in order to have X number of dollars when you get to the summit, when you get to the top of the mountain. So just to give you an idea, at a 5% rate of return, you need $1.5 million in 20 years in order to generate $75,000 of annual income once you get to the top of the mountain or the summit. Now, if you're 45 years of age and you have bought your homes and you're putting kids through college and you really haven't had the time to set money aside and invest money for retirement, obviously you're going to have to put a lot of money away in order to be able to have $1.5 million in savings. You're going to have to put away north of $45,000 a year at a 5% rate of return. And again, I'm using a linear example for this, but the market will go up and the market will go down. But if you do it on a consistent basis, there's a probability you'll get to $1.5 million in retirement. Now, provisional income calculations are very critical if you want to have a successful retirement plan. And I talk about provisional income calculations all the time because 99% of the people that I engage on a regular basis have never ever heard of the word provisional income. And if you do tax planning and at Cambridge, we specialize in tax planning, insurance, and investments, primarily alternative investments, and we'll talk about that in some of the other podcasts I will be doing fairly soon. But obviously, provisional income calculation is a must in order to reduce and or eliminate taxes in retirement. And why do I say that? Well, because when you start to come down the mountain, remember, if you put money away in qualified plans, they're really good while ascending the mountain. When you're climbing that mountain, they're really, really good because everything is pre-taxed. Now, they're not that good, and they're less than desirable while descending the mountain. Why? Because now you have to start paying. You're going to start paying taxes. You're going to have a tremendous amount of drag on your assets. And not only are you going to have to pay taxes on those assets that are inside your qualified plans, but because of the qualified plan distribution, it's also going to force some of the other vehicles that you have to be taxed as well. So in provisional income calculation, what we're trying to do is a couple of things. Number one, we want to reduce and or eliminate your tax liability at retirement. Number two, we want to make certain that your Social Security benefits do not pay any taxes. Now, Social Security benefits all by themselves are not taxable. Obviously, you did pay a tax when you contributed to your Social Security every single year while you were working. But upon retirement, is if 100% of your income came from Social Security benefits for you and your spouse, you would not have any tax liability whatsoever. What creates a tax liability for Social Security income is not Social Security itself, but all the additional incomes that you may have coming to you that could have a negative impact on your Social Security distribution. If you have no income coming out from other sources, then your Social Security taxation is zero. You will pay no federal income taxes on your Social Security benefit. If your income from other sources exceeds the threshold, or it meets the threshold or just goes above the threshold, then 50% of your Social Security benefits are going to be taxable. And if they exceed the overall threshold of $44,000 for a married couple filing jointly, then 85% of your Social Security benefits will be taxable. Now, provisional income calculations takes into account 50% of the Social Security benefits that you and your spouse received for the year. To that, in the calculation, you have to add, based on IRS rules, all of the distributions that you have taken from your qualified plans, your 401ks, IRAs, etc. You also need to add any other income from any part-time job if you're still working, and so forth. And then on top of that, if you happen to have been a good investor and you have capital gains distributions or stuff that you sold along the way during the year, then you have to add your capital gains distributions, and that could also entail the sale of some real estate properties or investment properties onto the calculation. And then last but not least, you have to add any municipal bond income that you have received in the given year. Yes, municipal bonds do generate a federal income tax free income calculation to the recipient, but the income that is received from municipal bond funds get added onto your provisional income calculation to determine what percentage of your Social Security benefits are going to be taxable. So there is a negative correlation between municipal bond funds many a times and Social Security distribution. Now, whenever I do planning for my clients, I prepare what I call a retirement bucket. And in the retirement bucket, we're going to have a number of vehicles in order to prepare my clients to climb the mountain and get to the top, to the summit, but also to start descending the mountain during retirement years. So there we're going to have traditional investments, and these are your 401ks and IRAs up to a certain limit, because we're going to do net present value calculations in order to make certain that we don't have too much money in those plans that will now have a negative impact on all the other assets that we have for retirement. We're also going to be contributing quite heavily to Roth IRAs and Roth 401ks, and then last but not least, we're going to be contributing heavily to PERP. And today I'm going to give you a sample of a PERP I completed just a few weeks ago for one of my best clients, so you can see the power of the PERP calculation. And a PERP is nothing more than a personal insurance retirement plan, but is done from an accumulation perspective, opposed to an insurance perspective. So obviously, those are things that are going to be very critical. And by the way, if you have too much money as you do your provisional income calculation, and you have to take too much money out of your traditional 401k and IRA accounts and some of the others pensions that you may have, you can also have a negative connotation on your capital gains. Because for thousands and thousands of dollars, if you have capital gains distributions, your tax bracket on those is 0%. But once you exceed a certain threshold, then 15% of those capital gains, or the capital gain distribution may be taxed at 15%, and for a number of my clients, even at 20%. So you have to make certain that, if you're going to bake a pie, you have to have the right amount of apple and sugar and yeast and so forth if you want to make certain that is going to work the right way for you. Now, let's talk a little bit, because I want to get into these numbers. Let's talk a little bit about what we consider the same way that I do a retirement bucket, where we identify how much money we're going to put in a 401k or a Roth 401k or a Roth IRA and in a PERP program, and we do in a combination of them all. Once we get into the PERP calculations, then I put together for my clients what is called a PERP bucket blueprint. And the reason for that is we want to make certain that the insurance program that is going to be placed on behalf of the client not only will allow the client to have maximum family protection, because no one ever dies at the right time, but most important, that it has maximum accumulation protection from a business perspective. So, for instance, normally we're going to start in this bucket blueprint that we're going to create. At the center of the bucket, we're going to use term life insurance. And we use term primarily for family protection. And the reason why we start with term insurance is that the premium on the term insurance is the cheapest when you're the youngest. So if you happen to be a 40 or 45-year-old or even a 50-year-old, we're going to secure either 20-year guaranteed level term insurance or a 30-year guaranteed level term insurance. And the reason for that is we want to secure insurability. Now, the term insurance policies that we use at Cambridge and the companies that we use at Cambridge, remember, we're an independent firm, so we are not married to any one company. We're married exclusively to our clients. We use term insurance products that are guaranteed. Now, let me get a little bit of water before I continue. Now, these term contracts have to be guaranteed. And what that means is that if the client gets issued preferred today, and 5 years from now, they have had cancer, they had a stroke, or they have diabetes, if we need to take a portion of that current term policy and convert it to a permanent policy, then the insurance company under the contract has to issue the term rate, the same term rate that was issued when the term policy was first purchased, onto the new permanent contract. So even if the client 5 years from now is uninsurable, the fact that we purchased that term insurance when the client was preferred, the new policy has to be issued preferred. And that is a critical aspect of what we do in creating a PERP bucket blueprint. Now, the reason why we have that term policy in place for 20 to 30 years is we want to guarantee the premium. And by the same token, we want to have enough time on our side of the ledger to make certain that by the time the client reaches retirement, that 100% of that term insurance policy, whether it's $1 million, $2 million, $3 million, $5 million, many of my clients purchase $10 million in term insurance policies. We want to make certain that all of it has already been converted to permanent life insurance. And here's where the know-how comes into place and comes into play. And also as you start to design a retirement distribution structured for a PERP bucket blueprint. when we start to convert some of that term insurance policy, depending on how much money the client wants to set aside or has the ability to set aside, the exercise I'm going to cover with you in a few minutes, it's a client that is putting away $24,000 a year, but we're going to use whole life as family protection. And we're going to use whole life because of the guarantees that whole life has. So we're going to start taking some of that term insurance and we're going to convert it to permanent whole life. And the reason for that is that you want to make certain, as a family member, especially if you love your family the way I love mine, you want to make certain that the life insurance policy does not die before you do. And term insurance policy does have the ability to do that because almost 98% of all term insurance policies die before the clients do because, once you get to a certain age, they become prohibitively expensive and most clients are going to cancel them. And that's why we want to secure term insurance early on, but we want to start converting those to permanent contracts as soon as possible. So in the very first scenario, we're going to take a portion of that term insurance and we're going to convert it to whole life. And that's going to be earmarked primarily for family protection. Now, that's going to be family protection, upon the death of either the husband or the wife. We want to make certain that the surviving spouse has enough assets to maintain their standard of living, also to offset the Social Security benefits that are going to be lost on the first death, because yes, the surviving spouse gets to pick the higher Social Security benefit, but one of them is going to go away, and obviously that's not really a good thing. You also want to be able to protect your children and so forth. So for that type of whole life contract, and this is where understanding insurance planning is so critical, we're going to use the lowest possible premium, guaranteed premium, for the highest death benefit possible. So here in this type of insurance contract, we're not truly interested in using it for income distribution as we're coming down the mountain, but we want to use it primarily for family protection in case something were to happen as we're either coming down the mountain and we have a premature death, or we ran out of gas and had a premature death as we were climbing up the mountain. So we want to make certain that we can get our families to the summit, whether we are there with them or not. Now, another portion, depending on the amount of assets that the client wants to create, is going to go into a retirement growth and distribution portfolio. And here we're going to use two different types of contracts. We're going to use an index universal life contract. And index universal life, one of the reasons why I like them is they allow our clients to participate in the upside potential of the stock market without having to participate in market losses. So yes, they do give up a little bit of the growth in the portfolio when the markets are heading north, but then the client's assets are totally protected when the market is heading south. So index are very, very good from a business perspective, because even if the market, let's say your portfolio is now up 20%, and the following year the market dropped 10%, while your assets in that portfolio of index do not drop at all. They stay at that 20% level. And then once the market recovers or starts to recover, then the clients in an index product are at a much better position than those clients that were totally naked as the tide went down and they lost that 10, 15, or 20%, and they have to start climbing the mountain all over again. When you use an index product, when you get to a certain area in the summit, it doesn't matter whether anyone else fell down the mountain. You hang on to where you're at the mountain, and then when the market recovers, and you'll continue your climb for many, many years to come. So in this scenario, we use for a portion of the investment in the index universal life. But here we do totally the opposite of what we did with the whole life in the previous scenario for family protection. Remember, when we did the whole life, we were looking for the lowest amount of premium and the highest death benefit possible. When we do the index universal life to create retirement growth and distribution access, we're using the opposite. We're using the highest possible premium with the lowest death benefit. And usually what we do there, and we're not going to get into this, we want to put as much money as we possibly can in these index universal life contracts to get us to the 7-pay. The 7-pay is an IRS rule that determines how much money can be placed into an insurance contract for the first 7 years, and so they're going to give you the minimum and the maximum, and you want to make certain that you don't go above that maximum, because then you create all types of taxable liabilities, and you create what is known as a MEC, which is a modified endowment contract, and that's something we don't want to do in an insurance contract. But by investing the most amount of money with the least amount of death benefit, it's allowing those assets to continue to grow significantly and at a much, much faster pace than in any other type of insurance program. Now, most insurance advisors in the marketplace will not do that, because they want to make certain that you can purchase the most amount of insurance for the highest amount of premium, because obviously the highest amount of premium that supports a death benefit also takes into consideration the amount of commissions that these advisors are going to be receiving. We do it totally the opposite way. We want to make certain that our clients generate the most amount of income out of these contracts, and that's why we do it this way. Now, if there's some additional money left, we also want to do the same thing that we did with the Index Universal Life, which meant we want to put the most amount of money in, or the highest possible premium, for the lowest death benefit, but we also want to do it with a whole life product. And the reason for that is, again, the guarantees of a whole life contract that has nothing to do with the ups and downs of the market. And here we're going to do the same thing. We're going to put the highest amount of premium, and we're going to choose the lowest amount of death benefit possible. So I'm going to give you a quick scenario, and then we're going to close this podcast, because I think it's important for you to understand how powerful this investment is if you do it the right way. Now, this client of mine, I've been working with this client now for about 5 years. And this client was in my office right before the end of the year, and he had some additional monies that he wanted to set aside. Now, because of the fact that he's in a 401k, he was only able to, max out. Now he's 45 years old, so he's only able to put $18,500 into his 401k, plus the match that he was getting from his employer. But obviously, we were not going to do any more than that. And for many years, I did recommend to this client not to max out the $18,500, but he decided he wanted to do that anyway. So at the end of the day was his decision. So I asked the client, he says, and what he said to me when he came into my office, he says, Bert, I wish I had the ability to put more money in my 401k. And I said, okay, well, why is that? It says, well, I'm not paying taxes on that money. I said, yes, but you are going to pay taxes on the whole thing at some point in time in the future. And he says, yeah, I know, you've been telling me that. But I said, well, let me ask you this. If you had the ability to put more money into your 401k right now, how much money would you be able to put away? He said, Bert, I can put away another $24,000 a year. I said, well, if that's the case, let me take a look at some of the options and let's see what we can come up with. Now, we were already maxing out on the Roth IRAs as well, and the Roth 401k, because his 401k also gave him the ability to put money away on a Roth. So he was actually making some contributions to that. So I did for him an index universal illustration which I showed him. And we were using conservative numbers from a business standpoint. And for this, the client was going to start putting away $24,000 a year, and he was going to fund this contract to the age of 65. Now, because of the fact that in this exercise, what I'm looking for to do is to have the highest amount of premium and the lowest amount of death benefit, the death benefit in this situation for this client was only $519,000. Now you say, wow, $24,000 of premium can support $2.5 million of death benefit, yet you're only using $519,000, and the reason for that is I want the majority of that money to go toward the building of the cash value reserves in the contract, so that my client at retirement can start pulling the money out on a tax preferred basis, and we'll talk about that in the next few minutes. So the client that was funding the $24,000 is funding the $24,000 on an annual basis, and using a conservative rate of return. By the time that my client reaches the age of 65, he's put $504,000 into this contract and has an accumulation value of almost $1 million, $966,000. Now, the beauty of life insurance as a personal insurance and retirement program is not on the accumulation rate, it's on the distribution rate. Remember, I said to you that qualified plans are very good when you put money and you're climbing the mountain. But when you start coming down the mountain, the taxes are going to eat you alive, and therefore the distribution rate is not comparable to what you do in other plans. But you can't have both of them at the same time, so we do combinations and we do straddles in order to make certain that our clients enjoy it on the way up and also enjoy it on the way down. Now, here's what the distribution will look for this client. Remember, he has only put $504,000 into this contract, $24,000 a year for 21 years. And now this client is going to have the ability to pull out $149,819 every single year for the next 20 years. And you're going to say, well, how can that be? And the reason for that is every single dollar that is coming out of this account now, it's tax-free, is not reportable for income to the IRS. So my client can now start taking distribution without having to worry about reporting this income to the IRS whatsoever. Now, the most important about this is that any income that comes out in retirement from either a Roth IRA account or a PERP, or a personal insurance and retirement program using life insurance, is totally tax-free, and do not, and I repeat, and do not create any tax liability for Social Security benefit distribution and or capital gains. This is completely and exclusively a tax-preferred retirement program. So remember, this client put in $504,000. The client started to pull money out until at the age of 66 until the age of 85. So he pulled money out for 20 years. Now he could do it for longer. He could do it for 25, 30 years. So instead of taking, $149,000 a year, he could take 120, he could take 100, whatever he or she deems necessary. Remember, in this situation, the client is not obligated to take the money out. So my client, he can take this money out on a given year. He can take $100,000 one year. He can take $200,000 another year. He could take nothing the following year. So he's got total control of this. The IRS does not force him to take any distribution, so that's a win-win. But at the end of 20 years, my client put in $504,000, was able to receive $1,893,000 in tax-free income distribution out of $504,000 investment. So that's an enormous an enormous tax benefit and distribution rate for this client in retirement. This client is going to be able to get to the summit. He's going to be able to come down the mountain safely without having to take shortcuts because he may be running out of money. Doesn't have to worry about the IRS, doesn't have to worry about where taxes are going to be in the future. And we all know that taxes are going to be a lot greater than they are today. And he's going to be able to enjoy a lifetime of almost $1.9 million in tax-free income for the rest of his life. Now, every year in this type of plan, the company allows us to diversify the portfolio. So once a year, the way that I set up this portfolio right now, we've invested in the S&P 1 year 500, in the S&P 3 year with 140% participation rate. We actually invested in a blended 1 year fund with 100% participation rate. I'm not going to go into the details. And then we also invested into the Euro Stock 50 with a 1 year and 100% participation. And depending on market conditions, we can change this portfolio on behalf of the client without issues and or concerns. Now, a final thought on this is, remember, because this is inside an insurance contract, there is no 59.5 rule for the client. So the client has the ability between the ages of 45 and age 59.5. If he needs money out of this contract for investments, opportunities, or emergencies, he has the ability to pull money out, pay no federal income taxes, and pay no penalties whatsoever. If the client has accumulated, which I'm sure he will because of all the numbers that I have done on his qualified plan, if he wants to allow this plan here to continue to grow without having to start pulling money out at age 65 and maybe wait till age 70, 75 to start pulling money out of this contract, he's going to be able to pull out close to $300,000 on a tax-free basis from this contract, and the IRS will not force him to take minimum required distributions at the age of 70 and a half, as the IRS does for qualified plans like IRAs and 401ks. So again, we went a little bit long today, but I thought it would be very important for you to understand the capabilities that we at Cambridge have when it comes to insurance and retirement distribution planning. And also remember that, again, a rising tide raises all ships. But only when the tide goes down will you know who is swimming naked. So swimming naked means not doing your due diligence, not understanding retirement options, not understanding how the mountain analogy is going to apply to your finances. And as I always say to all of you before I finish all of my podcast, the goal of myself and my firm is, to help you change the way that you see things. Because when you change the way that you see things, the things that you see change. Again, thank you so very much. Please feel free to reach out if you have any specific questions regarding this podcast or any other topic that we have covered throughout the last 20 some odd podcasts that we have conducted. So again, have a wonderful day, and we'll talk next week.